If you are looking for an intraday breakout strategy, pivot points might just be what you need. Here I will use them with the ATR indicator to capture trends on the euro-dollar.
Pivot points are a great tool for identifying market sentiment and support and resistance levels. They appear as a series of horizontal lines overlaid on prices. By default, pivot points are calculated at the start of the trading day, using the previous day's high, low and close prices, as per these equations. The central pivot is an indicator of market sentiment. The market is bullish when trading above the central pivot, and bearish when trading below it. The S1 to S3 and R1, 2 or 3 levels serve as intraday support and resistance, respectively. A breakout of these levels could indicate the beginning of a trend. We'll try to capture these breakouts on the 15-minute euro-dollar, using the second support and resistance levels, S2 and R2. The threshold for long breakouts will be the R2 level with a 1.5 times 30-period average true range buffer added to it. For shorts, the buffer will be subtracted from the S2 level. This additional ATR buffer helps filter out many false breakouts where we get a weak penetration of the support or resistance level due to random noise. I want to improve win rate by trading in the direction of the short-term momentum. For longs, the 20-period EMA will need to be above the 50-period EMA for at least 5 consecutive bars. This consecutive bars requirement produces a more stringent filter that reduces the likelihood of a single impulsive bar triggering an entry. Now let's add a time filter. When trading on the lower time frames, I always consider the use of an intraday time filter. There is a strong relationship between market volatility and the time of the day. In general, trend-following strategies perform best when liquidity is high, which occurs during the London and New York hours. Therefore, I will only allow entries in the 10 to 1800 hours window. You may obtain better backtest results by optimizing the time window, but sticking to conventional choices like this will reduce the risk of curve fitting. If the 2 entry conditions are met, I'll place a buy stop at the highest high of the previous 3 bars for longs, and a sell stop at the lowest low of the previous 3 bars for shorts. The confirmation provided by this simple breakout filter helps improve win rate. I recommend using a stop loss for all your strategies. I'll place my stop at 100 pips here. If you're trading a volatile market that reverses frequently, a trailing stop may be worthwhile. Finally, to avoid weekend gap risk, I'll exit all trades on Friday, 2 hours before the New York close. Here's an example of a successful Thursday trade that was closed out before the weekend. Notice how Friday's pivot points spread out drastically in response to Thursday's breakout. Now let's automate the strategy using AlgoWizard. I usually parameterize my strategies in case slight optimization is required. I'll calculate the daily pivots at the New York close, so I've input 0 for the start hour and minute. Be sure to use your broker's time zone. The Friday exit and intraday time filter are specified under trading options. Now let's backtest on the euro-dollar over 11 years. Not too shabby for such a simple strategy. Used by floor traders and part-time retail traders alike, pivot points have survived the test of time. Be sure to give it some consideration if you trade off support and resistance levels. If you're a long-term trader, weekly or even monthly pivots may make more sense. Or you prefer a mean reversion approach instead, check out the video at the top right. Thanks for watching, and do subscribe for more content.